Okay, I think we're gonna get moving. We're right on time. I don't know if the right MO is to give people a couple minutes to trickle in, particularly on day 4 at 8:30 in the morning, the prime slot that we've all been fighting for. But thank you all so much for coming in, and want to make this as valuable for you all as possible. Have prepared a little bit, but whatever I can prepare to speak on will be less interesting than what it is that you actually want to know about. So I'm going to try and get through the material that I have in sort of roughly 20-ish minutes, and I would much rather take questions and make this a conversation together. We're going to be a little disorganized on that front, in just that you raise your hand, you yell something, and I will do my best to hear, respond for the video, repeat the question for the video, and answer whatever questions you all may have, because honestly, we're here for you, and want to make the content as relevant as humanly possible. So my name is Dan Gill. I'm the Chief Product Officer at Carvana. I've been working with the company for about coming up on 5 years now. And it feels like maybe closer to 10 or 12 in how brutal it has been. But I'm going to start at a very high level and talk about retail broadly and competing inside of retail, how that bleeds into e-commerce, and how hard e-commerce is in automotive retail in particular. And then we'll get into a little bit more of the tactics of things that we've learned and trends that we see in trying to execute an online retail experience for Carvana in the automotive vertical. And then, like I said, let's get some questions going and make it as relevant as possible for all of you. So to start with, let's talk about, like I said, retail broadly and how hard it is to compete in retail. And I think there's probably no scrappier entrepreneurs than American independent auto dealers. It's a bare knuckle boxing match, and a really impressive business to succeed in. But if we're honest about how hard it is to compete, let's say if you're selling the same set of products, right? How do you compete inside of that market? And traditionally, there are sort of 3 vectors that you can compete on. You can compete on experience, customer experience. So that might be the domain of luxury retail and a really white glove experience, and that often comes with cost to provide a differentiated customer experience, but that's one way to stand out. It can come in the realm of selection. And so sort of classically, in other verticals, that was the domain of big box retail, right? That's where department stores came from, and that's where Best Buy and Circuit City and everybody came up, where you could go to one place and have the widest selection humanly possible that you might want to choose from, but maybe you're going to lose on experience a little bit in order to have that selection. Or you can compete on value. And my favorite example of competing on value is still Trader Joe's. I think that in order to sell the same set of products that other people sell at a lower price, you have to have structural innovation inside of your business. And in Trader Joe's case, what Trader Joe's does is it doesn't have 14 kinds of peanut butter. It has one kind of peanut butter. And it's like Trader Giotto's, or, they all have all their little mini brands that they white label, but they concentrate all of their demand onto one supplier. They get scale deals for doing that. They remove selection and choice from the consumer. They remove basically all marketing spend and are therefore able to offer the same set of products, very high quality products, at a lower price because of intense structural innovation inside of their model. So the point is that it's very hard to compete. You've got to kind of pick your battles and decide, do I want to be an experienced brand? Do I want to win on breadth of selection with maybe lower margins? Or do I want to be lower price and lower margin? And how do I want to balance those things in a retail environment? And that's very difficult. I think that what e-commerce has aspired to do, and certainly aspirational at Carvana, is how can we win at all 3 of these things simultaneously? How can we leverage what e-commerce unlocks for consumer experience to win at experience, selection, and value all at the same time? And I think that the closest that we've seen to that in the retail environment is Amazon, where you start with on a selection basis, big box retail was the infinite selection. Truly infinite selection is the internet. It's a search box, and there is no shelf space limitations or parking limitations. It is the infinite shelf space of the internet that you can search through. On the value side, you can have remove the costs of the big box retail experience and try and offer a lower price to consumers. And from an experience perspective, Amazon has invested so heavily in logistics and fulfillment to provide rapid delivery times, super convenient, right to your door, and return any product very, very simply. And so that's how we think about the opportunity that we're pursuing at Carvana, and certainly we're making mistakes left and right, but learning a lot along the way, and hopefully we can have a good discussion around that today. So let's talk about that, about e-commerce, and we're going to then pull that into automotive. First and foremost, we talked about the selection advantage, and we'll come back to that, but the other part of e-commerce, that the expectation that Amazon has set in the minds of consumers is open 24 hours a day, 7 days a week, right? And free delivery to your door. And that's a very difficult value proposition, as we all know. But that is more and more and more what the consumer expectation and the consumer mindset is around how I get what I want. I go online, and then it gets brought to my door. And I can do it whenever I want, at any time of day, 24/7. And as we know, there's a lot of impediments that make that difficult in our business. And so we'll go a little bit deeper on some of those. But first, do people even want that in automotive retail, right? This is a little bit age data, but I don't think any of us would quibble too much directionally with what it says. One is that 97% of purchases involve online research. Arguably, it's 99.5 at this point. Might be 90, but it's certainly not less than that. 75% of consumers would consider purchasing a car online. Irrespective of what that data point says, I think it's sort of a misleading data point, right? Because if you ask, depends how you phrase the question. If you ask a customer, do you want to buy a car online? A lot of people are going to say, no, that's weird. I would test drive a car. I'm an adult, right? But if you start to say, would you like to be able to buy a car online, have it brought to your door, return it for any reason within 7 days, have a 100-day warranty on it, those kinds of things, that's a very different value proposition. That's not just, do you want to buy a car through the internet, right? And so I think you have to be very clear about what the value proposition is that you're offering. The other, and the biggest objection that anyone easily has with Carvana at any time is, how could I buy a car without test driving it first? And what the data says is that approximately 17% of people don't test drive a car. They come in, they know the car that they want, they look at it, and they drive it off the lot. And 35% of people test drive only one vehicle. They find the one they want, they take it for a test drive, and then they go. And so technically, if you're going to bring one car to someone's door and they can return it for any reason, they're getting the exact same experience that 52% of people are already getting. And so the notion of needing to test drive many, many, many vehicles might be a use case that certainly some consumers have, right? But the data shows that it's not the modal use case, and it's not the only way that consumers like to buy cars. And so this suggests that there is an opportunity to provide that e-commerce experience inside of automotive retail. And so, but let's talk about other reasons that that's really, really hard. Because if we want to be open 24 hours a day, 7 days a week, and allow that self-service experience, there's a couple major impediments to that. One, automotive retail, generally speaking, requires financing. And as we all know, financing is not a straightforward process. And so you need to collect data from the consumer, and then you need to get it out to lenders who can decision based on that customer information. And there's dealer track and there's Route 1, but generally speaking, those decisions are collateral dependent, and so you need to know what car the customer is buying, and oftentimes there's human intervention to decide exactly what terms and what steps you'll need in order to lend to that customer. At Carvana, we are our own lender, so we do our own proprietary credit scoring, loan structuring, loan decisioning, and underwriting of our deals. And that has allowed us to have a completely self-service, deterministic model where, because it is our collateral and our credit models, we are able to decision instantaneously with no human intervention, 24 hours a day, 7 days a week. Another piece of that is that many transactions require a trade-in. And the general sense inside of the automotive industry, and we took a lot of heat for this for a long time, is that you cannot value vehicles sight unseen and make money. Can't do it. And that's not our experience. And I think many of you in the room probably have innovated and found ways to give people accurate trade valuations through a web experience. And that's another part of the transaction where you're trying to make a whole deal pencil. You need to be able to accurately value the vehicle that they have and integrate that in with the financing. So similarly, you can go to Carvana.com, you can input your VIN or your license plate, answer a couple of questions, no photos, no inspection, nothing, and we will give you a to-the-penny accurate firm offer for your car, and it's automated for over 98% of vehicles that come through our system. And so in that case, now again, at 1:30 in the morning on a Tuesday, you can go on the website, you can do a soft credit pull, you can get a value for your vehicle, and you now have to-the-penny accurate terms for 19,000 cars in our inventory, calculated for your geography, down to the penny monthly payment, and everything inclusive of bringing the car straight to your door. So those are some huge impediments, is to make a self-service transaction when there are these very complex finance and trade-in valuation components to them. You've got to really make a leap to say, we can make those things self-service. And that's part of the technology that we've built at Carvana. The last piece is that in order to take advantage of that centralized inventory, so I mentioned earlier the notion that the infinite shelf space of the internet can be an advantage, right? Being able to search across 15, 20,000 vehicles is great. But if you can't get those vehicles to the customer quickly, it doesn't matter, right? Telling a customer, hey, choose from 30,000 vehicles and I'll get it to you somewhere between 4 and 11 days from now is just not a value proposition that resonates with consumers. That's not the expectation that Amazon and everyone else is setting in consumers' minds. And one thing, I don't come from a deep background in automotive retail, one thing that shocked me was how impulsive these decisions are. We find that the conversion rate, if we can get a car to a customer as soon as the next day versus 6 days, is very steep, extremely steep, right? And so people are far more likely to complete a transaction if they get that, that instant gratification rush of, wow, you're going to bring this thing to me tomorrow, and they convert at a much, much, much higher rate. But that's really hard, because if you want to have a huge volume of vehicles, where are all of those vehicles, right? Where are you going to store them, all of those kinds of things. And unlike Amazon, that when they started selling books, from day one they could tell UPS, USPS, FedEx, hey, buy a book online and we'll ship it to you, and they just had to go get the books and give it to a fulfillment engine. That's not how automotive hauling works. And so we had to build a nationwide logistics network. So those gray, the cross wrenches are essentially what Carvana calls inspection and reconditioning centers. And so these are, 60 to 80 acre facilities that are capable of reconditioning up to 50,000 cars a year each. And we park around 4,500 cars at each of them. And they're connected via a first-party logistics network that we own and operate. So a 9-car hauler network with Carvana employees and Carvana drivers that then connect out to market hubs in about 80 cities in the United States, where we call it where the big truck meets the little truck. So the big trucks come, they drop off sales in that market, and single car haulers go out and back and deliver to our customers' doors. And so we had to build that entire value chain so that we could get the benefits of those centralized pools of inventory and the breadth of selection in order to provide that advantage of an e-commerce model to our customers. And so far, it's been a harrowing ride, but we're really seeing traction. And so I'm a startup guy. I've worked in startups my whole career, and sort of coming from Silicon Valley, the goal is to either go through a huge acquisition or ideally you build a long-term sustainable business and you can take that company public and sustain. So these were some of our numbers when we IPO'd in April of 2017. We took the company public. We were showing positive momentum on the left in terms of unit volume growth. We were showing some positive momentum in terms of being able to generate some gross profit per unit, but for all of you in the room, that's an unsustainable amount of gross profit per unit, and still losing a lot of money. Since that time, we've grown precipitously. So those blue bars on the left are still the blue bars on the left. The gross profit per unit has continued to build momentum, and our EBITDA margins are improving dramatically. And so what we're showing is that as we build more scale, the economics of this model, while they're very capital intensive to get off the ground, provide a customer experience that really resonates with consumers, and we see that with the unit volume growth on the left. We're finding we're able to do it in a way where we can generate substantial gross profit per unit, and we're finding that we're going to be able to build, it doesn't, if you follow a trend, that trend on the right, full transparency, at Carvana we take a lot of guff about losing money. It costs a lot of money to build what we're doing, and I know many independent entrepreneurs don't have the luxury of losing money for a period of time until you build something huge. We have had that luxury, but that trend line isn't going to just take a hard right. It's going to continue, and we feel very confident in the momentum that we have to build a long-term sustainable business. The rocket fuel for that is that we obsess over our customers at absolutely every turn. So this is, as of December, it's actually 33,000 reviews now. We maintain a 4.7 out of 5-star rating. We do not suppress reviews. These are all verified customers. Every review that's been given to us goes into this calculation. An 82 Net Promoter Score is, in the realm of Apple and the most beloved brands in the United States. And that's because we obsess over our customer experience in every way. We have a team called our Executive Resolution Team. And inside of our CRM, there's a button that says "We messed up," and anyone at any time is encouraged to click the "We messed up" button. It sends a note to the Executive Resolution Team and says, "We screwed something up," and we reach out to the customer proactively and try and fix the problem before they tell us about it. And that kind of behavior is woven into absolutely every aspect of our culture, and how we think about spending our money, how we think about removing costs from our fulfillment model so that we can put more money into that differentiated customer experience. And this has really been the rocket fuel for our growth. So hopefully that gives a small, sort of 30,000-foot overview of the components of Carvana and how we think about creating a true e-commerce model inside of automotive retail. I'm going to get into a little bit of kind of lessons learned and things that we see and trends that we see from that customer experience. And then, like I said, it's way more interesting for us to have a conversation. So start thinking if you've got some questions, and I'll be happy to answer them. So one thing that we've learned, transparency and simplicity are key. And here's some stats for that. 25% of our customers complete the entire transaction from their phone. Now, the majority of our website traffic is on mobile devices, but 25% of customers complete the entire transaction without ever leaving their phone, right? Which is a staggering number, from buying a car, financing, getting a trade value, signing with your finger in an e-commerce, e-contracting rather. It's a staggering number. 50% of our customers get all the way through selecting their car, getting their financing, getting their trade-in valuation, and scheduling their delivery without ever speaking to a human being. We then have a very large contact center based in Phoenix, where we're headquartered, where we say if you don't want to buy a car online, you don't have to. You can call in and we'll help you at any time and walk you through the process. And also we have to do underwriting because we're a lender. And so there is, generally speaking, in the underwriting process, there is some coordination with the customer, but we're obsessed with trying to turn that as self-service and automated as possible. And third, this is the one that I think is most surprising, is that 70% of customers finance directly with Carvana. So I mentioned earlier that we're a lender, and yet certainly if we had surveyed customers, would you like to, 1, buy a car online? No. 2, would you like to get a loan from Carvana? Who is Carvana? Why would I do that? I have a bank, right? And yet we have seen greater than 60% penetration on our own finance offering, and now greater than 70% penetration on our finance offering at very sustained rates, because of the customer experience, right? It is so seamlessly integrated and simple inside of the customer experience to get your loan terms, and there's no games. I know that when we, at various points of building our technology, had some inconsistencies in our back end, where if you were on search, it might show a monthly payment of $210, and then you would go to the vehicle details page and see a payment of $215, and we would get called out, right? This says one thing, this says the other. I want the 210. What are you trying to do to me? You're trying to screw me over. What is this, right? And so you can't have that. And so what we strive for is to the penny accurate every time, everywhere on the site. And there's other little things that we do. You can, because we're pre-calculating all of our terms, you can have any loan term that you want. If you want a 41-month loan term or a 66-month loan term, We don't care. Now, it is not that we actually believe that people want 66-month loan terms. It's that the feeling that I'm in control as a consumer is really confidence inspiring. It's that I'm making the choice on my terms, and there's nobody trying to screw me or hide things from me as far as what my finance terms actually are. And that's the same thing with our trade-in valuations and every other part of the transaction. So we really believe in that seamless, transparent, simple customer experience and see that borne out inside of our data. Another is to set clear expectations. And so I'm going to presume that some of you have been on Carvana before or maybe seen how we photograph our vehicles. Sure. Yeah, we do full spectrum lending. Yeah. And we can talk about that. Another piece is setting clear expectations. So this has been a big theme as well, and something that our founder and CEO, Ernie Garcia, is a brilliant guy with a lot of vision, and he saw this very early, is that if the number one objection to why you can't buy a car online is that I want to test drive that car, we can't do that. We don't have a means to get all of our cars to you to test drive, and we don't plan to do that. So what can we do to transfer as much information from us to you as possible? Because that's what the test drive is. The test drive is me gaining confidence that this is the car I actually want, right? And when you're walking that car, you're kind of silently accepting little bumps and bruises, and you're getting comfortable, and really what you're doing is you're giving yourself the confidence to pull the trigger that you want that car. And we can't give you that. And so what can we give you? We can give you as much information as humanly possible. So we're going to do high-resolution photography in 360 degrees. If there is a bump or a scratch that we didn't fix, we're going to take an up-close photo of that and put a big yellow mark on it and encourage you to go look at it. Because we say that disappointment is the distance between expectation and reality. And so if you set sky-high expectations and pull up with a junker, you're going to have a really hard time having referenceable customers. But if you set super accurate expectations of exactly what the customer is getting, you're going to find much, much happier customers at the other end. And so we find that that's true with photography, that's true with vehicle data, and I think all of us, especially in the independent world, know how hard it is to turn a VIN into a fully described vehicle. It is mind-boggling to me why that hasn't been made easier, but it hasn't. And getting all the way down to options and packages and decoding that into something that a consumer can actually understand is very difficult, and we invest heavily in trying to turn a VIN into a fully described vehicle in an automated way, all because we want to try and set the most accurate expectations that we can for the customer so that they're never surprised with what shows up at their driveway. And last is that technology unlocks scale. So in part, when all you got is a hammer, everything looks like a nail. I'm a very nerdy guy. I've been building technology for a long time, and so I love technology, and this is what I do. But we have built a lot of proprietary technology inside of Carvana. And so if we look at this sort of life cycle, what we have here is that little brain with the halo on it. At the bottom left, it says it's proprietary ML and or AI, machine learning and or artificial intelligence. We've built algorithmic decisioning and machine learning models through all parts of our transaction. Whether that's vehicle sourcing, we ingest data on every vehicle available in the wholesale market every day and determine based on the demand side data that we have and the supply that we have on hand what the optimal units are to add to our inventory mix. How we price is algorithmically determined and leverages machine learning. Our reconditioning process is still, that's hard work. That's just a lot of people and a lot of cars doing hard work. Our photography has a whole computer vision and machine learning pipeline for processing all of those images and making them available through the web experience. Our transportation network is real-time optimized to determine what vehicles to put on what routes, when and why, all of that. And so this is us trying to create scale where how can we take these really, really hard problems that at scale are not human scale problems, right? To determine which vehicle to put on which route when you're trying to connect 7 reconditioning centers and 150 markets is not a human scale problem. And so we leverage technology at every part of our customer experience and our operational experience to try and tie all those systems together and all those decisions together in a way that creates that final customer experience. So those are some of the things that we think about. And as I've kept saying, I would much rather have a conversation and answer questions that you all have, and we can go back to any part of this, but I'm here for you. So anything that you want to know, I will do my best to be an open book. Being public has a couple of limitations, but I'll do my best to be transparent. Sir? Yeah, so the question is, what are our plans for future growth and being in other markets? Yeah, Ernie, it was sort of funny, but not. He was asked that question on stage at NIADA 2 years ago. They said, so we heard you just expanded into San Diego. Why did you do that? And he said, there are people in San Diego, which was, meant as a joke, but also true. We do want to provide this offering to as large a market as possible because there are economies of scale to our business. Frankly, the more demand we put on our centralized supply, the faster those vehicles turn. So we do want to continue expanding. The biggest fear that we have is how do we expand without diluting our customer experience? That has been everything as far as our growth. And we've been very, very fortunate to have positive market conditions and all those things. But if we can't keep that positive customer experience of a Carvana uniformed employee in a Carvana hauler, showing up with an iPad in hand, providing absolutely exceptional customer service, that's where we're going to really stumble. And so we want to grow and expand as fast as we can without diluting that offering. Sure. Yep. It means we're probably very thin there. And so you can think about the hard part for us is when those logistics distances are really long, then the delivery times to our customers are also long and expensive, right? And so we want to concentrate our markets proximal to our supply. And we started with supply only in Atlanta, Georgia, and we only sold cars to people in Atlanta. And then we added Nashville and Birmingham and Charlotte and Raleigh. And then we put an inventory center in Fort Worth, Texas. And we connected those two inventory centers so that all the inventory available at both of those inventory centers are available to all the Texas markets and all the markets around Atlanta, and connect those together. Then we add another inventory center and another inventory center. The truth is, the West and Midwest and North is quite far from where the vast majority of our inventory is. And so for us to try and make a really concerted push there is very difficult. It's expensive, it's slow, and so as we expand our inventory density elsewhere, and we actually have some opportunities where we want to partner with dealers in that regard too, where how we can leverage more local inventory with our finance platform and our logistics network to provide more vehicles to the demand that we're generating on Carvana. So that's going to be another interesting opportunity for hopefully us all in this room. We're still very early, and so it's a little early for me to talk a ton about it, but the short answer is that we see an opportunity where we generate a lot of demand on Carvana.com. You've probably seen we spend a lot of money advertising on TV because we believe we're building a long-term sustaining nationwide brand, right? So we're generating a lot of traffic to come to Carvana.com, and generally speaking, dealers are selling the vast majority of their inventory within, let's call it 50 miles of where you are. If we can put 1,000 miles of demand on your cars, those cars should turn faster. And as a lender ourselves, we make a good margin on lending. How do we work out economics that say if you can turn more cars faster and we can create incremental margin through our finance offerings, and then there's real economics there that make a lot of sense. But it's still very early for that. Yes.
Do you prioritize your inventory on the search? So I'm looking at Dan's website there, and I'm looking at this BMW, and it happens. So how do you do that? Like when you look at the listings, is it just
great question?
And then do you start trying to manage their expectation level? That or is it take you 3 weeks?
You got it. You got it. So the question is, if someone is on the website and they're in San Diego and they're looking at a car that's in Philadelphia, will we bring that customer that car, and how do we do that? So the answer is yes, we do that, but there's a couple asterisks in that. So first, when you come to the website, we're going to use your IP address to figure out where you are, and we're going to do our best to say you're in San Diego right now, and that does influence the sort order of our search to say, well, let's show you all the cars that are as close to you as possible. Our closest inventory center to San Diego is Phoenix, so we're going to try and show you cars that are in our Tolleson facility, but we don't suppress much inventory. What we do is say, if you're looking at something that has lots of substitutes, So let's use the classic Honda Civic. We have hundreds and hundreds and hundreds of Honda Civics. If you are looking at a black Honda Civic with 30,000 miles that happens to be in Philadelphia, and we have one of those that's in Phoenix, we will charge you to move the one from Philadelphia all the way to San Diego because there's one very much like it that's much closer to you. If you're looking at a yellow Camaro with a black stripe and we only have one of those, then we're going to let that car go and we're going to move it across the country for you because we want to turn that car as fast as possible. We want to put maximum demand at the lowest price possible. And because it's first-party logistics, well, it's not cheap at all to move a car from Philadelphia to San Diego. It is much cheaper to do it when you're using your own logistics. And so, we're able to do that in a way that at large scale isn't particularly damaging, and we're trying to steer customers to inventory that is proximal to them. Yeah, great question. Average question is, what is our average credit score and how low will we go? Our average credit score is the distribution of the average used car buyer. And so we look like a completely normal distribution of the American used car buyer. And so we go all the way. We will approve essentially 99.9% of soft credit pulls that come through our system unless you have an active bankruptcy, essentially. Now, what we do inside of that is it's hard because we're one price. We're one price nationwide. We're one price for all customers. And so how do you structure a deal that works there? And generally speaking, that's using the combination of minimum down payment and erecting that as a barrier. If you're a low FICO customer but can pull together $3,000, you actually may be a pretty good credit risk. And so all of our credit modeling is built to understand that. And so it is a completely proprietary credit score that we've built. As some of you may or may not know, we spun out of a group called DriveTime, and DriveTime's been in subprime lending for more than 20 years and has an incredible amount of expertise there. We adapted some of their technology, built our own from scratch, but had a lot of lessons learned from their business that we could apply in our environment. So we are able to do full spectrum automated decisioning and lending. They're not. So the question was, the 7-day return, is the customer responsible for giving us the car back, and does it cost them anything? So no, it's completely free, and we come and get it from you. And if you gave us a trade-in, we hold that trade-in for that 7-day period so that if you don't want the car that we sold to you, we're going to bring you your trade-in back. Now, everyone asks, well, then how often does that happen? And the public numbers that we give is that we say we're in the high single digits of the number of people who want to return a car. More than half of those people want just another car from us. They like the experience. They were happy with the price. They were happy with the car. They just want a different car. And so we'll allow them and we'll swap that out. The key there is that if you think about the economics, that's not crippling, right? It's sending a single car hauler out, going and getting the car, so you're taking some excess depreciation on the car that we put out and bringing it back. We may need to refresh that before we can sell it to somebody else, whatever. Where it can get bad is if you can't control that return rate, right? And so how do you control that return rate? One, it goes back to setting clear expectations about the car that you're going to deliver to them. So if it shows up and it's different than advertised, your return rate is going to spike. If it shows up and you don't have a good reconditioning process and you don't have high-quality vehicles, your return rate is going to spike, right? Any form of separation between expectation and reality is what's going to get you in trouble. And so we obsess over that vehicle quality, that vehicle transparency, and then when we screw something up, we're going to call you and we're going to try and make it right before you have the opportunity to tell us that we tried to screw you. So I think those are the things that kind of come together that allow that return rate to be manageable, and how we also end up with more swaps than actually net returns. Yep. Do we have any cross-selling opportunities? So I'm assuming you mean ancillary products? Yep. And then what percentage of our business is subprime? So the cross-selling opportunities today, we offer vehicle service contracts and gap insurance. And our penetration rates are lower than I'm sure all of yours. It is a completely self-service experience, and you all yourselves and on your teams have trained professionals that know how to walk a customer through that value proposition and help them attach the products that are right for them. Ours is a completely self-service checkout flow, and so our penetration rates are lower than the market. And I think we see a lot of opportunity there for machine learning and personalization on the technology side. We also see opportunities to expand our option set to all kinds of other products that people want. Prepaid maintenance and key fob insurance and tire and wheel and dent and ding and all the things that actually there's a lot of demand for from customers. So we can see opportunities to expand our offerings there in the future. The other piece is, you asked about the percentage subprime. Again, our distribution looks exactly like the distribution of the industry at large. That's a great question. One thing that we try and admit a lot is that we're a 6-year-old company, and so we screw up all kinds of things. And there's lots of things that I think I'll give us like a B+ in some areas, and then a whole lot of C's. And I think on the advertising side, we believe sort of in two ways. We want to build a sustaining brand. And building a brand that's as complex as buy a car online, have it delivered to your door is a pretty tough value proposition to articulate because it's so different from how every other vehicle is sold. And so we invest a lot in TV to try and tell that story because that's the best medium to try. You get at least 15 seconds, maybe 30 seconds to try and get that story across. And that's really kind of like the overarching brand. But the reality is, if the customer buys a car on average once every 5 years, in expectation, 1 in 60 people that see your commercial in any given month are in market to buy a car. And so that's hard. We're investing very, very heavily in brand there. We do see and have gotten much more sophisticated in how our TV spend drives traffic to our website and feel very, very confident that TV is a great medium. We're layering in digital video, OTT, YouTube, Hulu, those kinds of things on top of that. We then at the same time want more direct response modes. So that's the listings partners, the True Cars and the Car Gurus and the Auto Traders and Cars.com, et cetera. And then as a lender, we work with various lending partners where we can showcase our finance terms, et cetera. So we do a lot of sort of direct response as well. So we're always just trying to have the right blend that's allowing us to grow at the rate we want while demonstrating decreasing customer acquisition costs. That's you. You got it. We don't have a solution to that problem. So the question is, the problem with e-contracting is that the auto disclosure needs a wet signature. We collect a wet signature. So, pardon me? When we deliver the car. So the vast, vast, vast majority of our experiences involve a Carvana customer or a Carvana employee interacting with the customer at that point of delivery, and that's where we collect any wet signatures that are necessary state by state. That's another messy problem, is that every state has different paperwork and different requirements, and we need to dynamically generate those packets. That's another mess. I'll come back to you. You already had one.
Maybe the elephant in the room. Two-part question. What's your 10 and 15-year goal? And is your MO kind of to take us out? Don't take that personally, because I think everybody in this room kind of wishes you would go away.
Yeah. Well, look. Here's what I would say. You're all entrepreneurs, and we're entrepreneurs, right? And nobody ever believed you're starting your own business because it's a walk in the park and that you are guaranteed your market share forever just by existing and starting a business, right? And so it's a fight. And you have to provide incredible customer experiences, figure out how your operating expenses work, and turn out a profit at the end. And you are all incredible entrepreneurs at doing that. That's going to continue to be the competition, right? Is that you have to provide the best customer experience possible. The great thing about our business is that the largest player in the history of automotive retail has gotten to less than 2% in used automotive. That's CarMax, right? That's how fragmented and gigantic our industry is. And so we went out and we're very blustery and we're very confident that we can build something that's differentiated. And we said we can sell 2 million cars a year. That's still 5% of the market spread across the entire nation, right? So the likelihood that we take out the best dealers is 0. We're not going to be able to beat everybody at the same time. It's just simply It is not a situation where we just order more books, store them in a warehouse, and leverage third-party shipping to get them out, and we just have to build a brand. We have to source cars, recondition cars, park them, photograph them, park them, transport them. It's an operationally intensive business to do what we do and to do what you all do. And so there is no universe where we take you out. It just doesn't happen like that. It is simply too operationally intensive for us to build that level of scale. Now, do I think that the worst dealers should lose? Yes. I think that in any competitive environment, if you're not great at what you do, you shouldn't win. And I think that we all would agree with that, and that's an entrepreneurial journey. So, but the likelihood that we can take over the whole market is zero. It's just simply too large. What's that? Okay. Back there. I do, yeah. And so yes, do I own stock in the company? Every Carvana employee, all of them, truck drivers, reconditioning employees, own stock in the company. That's been part of our promise to our employees from the beginning.
I have to ask about the full vending machines you have. Is that a marketing gimmick? Does it really work?
Yep.
Do I fill up at any point?
Yep. The question is the vending machines. So if you've ever seen our vending machine towers, they're part gimmick, right? And a lot of people like to say that they're totally gimmick, but I'll explain slightly. What it is our general philosophy is how is it that we're managing our variable operating expenses per unit? What does it cost for us to execute a transaction of getting a car to a customer, right? And we're very meticulous at understanding what all the subcomponents are of fulfilling on that transaction and how do we make those as scalable as humanly possible. So delivering to someone's door is a cost. If instead we can get someone to come pick up the car from us, that's a net savings, right? And that's good. That's good for our business. And so what we did is we started in Atlanta, and we said if we can get people to come pick up, that'd be great. But if we're going to ask them to come pick up the car, we better make it a good experience. It's got to be worth them coming down. So the first version was we gutted a sort of a service center and glassed out the doors, and you could type in a code, and the door would open, and you could drive the car out. And people loved it. And it was on yahoo.com. It's like the first car vending machine. And so then we really leaned into that. They're like, wow, people really like this, and this vending machine is really cool. And so we turned it into a literal vending machine. It's a tower, and you go in, and you put a coin in, and we go and get the car from the tower, put it in a bay, and you can drive it away. Now, what that actually is that in all of our markets, like I said, we need somewhere where the big truck meets the little truck. So we need a place to drop off inventory from our massive centralized inventory reconditioning center, inspection reconditioning centers. We need somewhere to put those cars where we can then put them on a single car hauler and deliver them to customers. And so it is our operational footprint, but we don't want to have a huge acreage. And so we build up, not out. And it gives us the opportunity to bring customers. And then generally speaking, those are on freeway frontage, and they act as a great way of getting the word out about our brand. So it is a marketing opportunity. It is an major operational component in our business, and it is a means of saving operational expenses by having people pick up from us. Who hasn't? Yeah. So the question is if cars go to self-driving, what happens there? I think that's a really fun question, and unfortunately I have like a 2-hour answer, but I'll try and be succinct. I think that cars going to autonomy is very different than ownership going away. And how that breaks in percentages has a lot to do for all of us, right? I think that if you imagine a world, which I think we all would love autonomous vehicles. I text and drive. I would rather text and sit. And so I think we would all prefer to be in an autonomous vehicle at some point if it can fulfill 100% of the use cases we need from our cars, right? But to get to that point is going to take a long time. Like navigating the drop-off at my kid's preschool is a harrowing experience. So that's going to take a while. And then for ownership to go away, that would suggest all the cars are owned by Uber and Lyft and Google, for example, right? And yet, in order to build a fleet that large that can handle maximum capacity, so not, everybody says cars are only used 8% of the time. Well, that's not totally true. What percentage of cars are used between 6:30 a.m. and 11 a.m. and 2:30 p.m. and 8 p.m. at peak demand? It's very different. So you need a fleet that can handle peak demand, not average demand. So that's a big fleet. If you're going to build a fleet that size, that means the technology for the autonomous vehicles has to get cheap enough. Well, if the technology is getting cheap enough, then we'll probably own our own vehicles, right? And so I don't know how that's going to play out, but what we believe is that those vehicles will need maintenance, and they will need, I don't think ownership is going to go to zero by any stretch of the imagination. We like to throw our gym bags and our car seats and whatnot in our cars. And so, we're going to try and, prepare ourselves to be agile at bringing cars to consumers who continue to own them, whether they're autonomous or not. And if everything goes to nobody owns cars anymore, that's a harder problem. I think it's going to take a minute.
Do you guys start with prioritizing your customer experience and where you focus your efforts first? And are you prioritizing the same thing?
Yeah. So he asked, do we prioritize customer experience first? It's an unquestioned yes. It is literally the only thing that our CEO talks about at all hands meetings is, hey, we saw a dip in our NPS in this particular category or this part of the funnel. Here's how we think about that. Here's what we're going to do about that. It's the only thing, especially in an all hands context, that is the only thing that's ever discussed is how do we make sure we're not diluting our customer experience as we continue to grow this thing. And so everything starts with, what is it that we would want? What is it that we would want as we were buying cars, right? And I would say certainly early, it wasn't about market research and that kind of thing. Ernie's just way smarter than me. So he's a really bright guy, and it was kind of coming from him. And then over time, we've certainly layered in tons of hard-learned lessons and enormous volumes of data and a lot of getting yelled at and that kind of thing. But it is always the central focus for the business. Yep, so we haven't given a firm projection on when we expect it to happen, but I think if you go back to those charts of our gross profit per unit and of our EBITDA, those lines are very steeply up and to the right. And so what we did do is we did an analyst day last November, and our CFO stood up and told exactly that story and said, we want to be the biggest and the most profitable automotive retailer ever built. And he walked through how we get there on a gross profit per unit basis without needing to raise our prices. And so that comes from buying more cars directly from customers instead of sourcing from auction. There's greater spread there. That comes from turning our cars faster, putting more demand on centralized supply and turning them faster. That comes from adding incremental ancillary products. That comes from the fact that as a lender, we used to sort of have one counterparty that would buy our loans. We did our first securitization earlier this year, where we're now tapping into the securitization markets, and we get more spread on our finance receivables in that regard. So there's lots of ways that we expand our gross profit per unit without changing our customer experience at all. And so then the other part of it is, we've got to pay for, Carvana is basically, instead of a moderate amount of fixed costs to kind of get off the ground and then a lot of variable costs on every transaction, we're an enormous amount of fixed costs to get off the ground, right? Software engineers and data scientists and a nationwide logistics network and all these kinds of things, enormous amount of fixed costs, but lower variable costs, right? And so for us to sell 10x more cars, I don't need 10 times as many software developers, right? And so we're starting to get enormous amounts of leverage through our corporate headcount as well. And so we think gross profit per unit is going to continue on the trend that it is and feel very, very comfortable that we're building a sustainable, profitable business.
So what is your goal for gross profit per car?
What we articulated in the analyst day, and this is not a goal, I'll separate the two concepts. We articulated that we believe, without changing our customer experience or raising prices, we can do $4,800 a unit, right? Now, that's insane. Will we ever get there? No. Do we think we want to be there? No. But what that says is that if we are great at what we do and we obsess over all the line items of our variable operating expenses and obsess over machine learning and personalization to get people to attach ancillary products, et cetera, hypothetically, we believe we can get there just by getting to industry benchmarks on trade-in attach rate, finance attach rate, getting our cost of funds and our financing where we believe it should be. All of those kinds of line items add up to that number. But one, we're not going to get there. Two, the goal wouldn't be to get there. The goal is to then have control around, our interest rates and our pricing and, all of those sorts of things to try and make the customer experience as good as we can. So what we have articulated to the market is that our midterm goal is to get over $3,000 a unit, and that's front end and back end. Yeah. Yeah, I think where Now, that was as of Q1, and we haven't done our Q2 numbers publicly, but I think that showed us at $2,400 a unit, or $2,390, something like that. It's a good question. The question is, are there any plans for us to monetize the technology that we've built? I would say there's much more plan to partner with great dealers. And so, I alluded to the fact that we don't have any cars in Minneapolis, right? We're far from there. But there's great dealers who have cars in Minneapolis, and we have a bunch of demand in Chicago and other places. How can we put our demand on your supply? Is, I think, an interesting model. And if we do things like that, what else can we do to help you better run your business? And in those kinds of cases where there's a symbiosis around vehicle quality and that obsession with vehicle quality and a velocity mindset around turning vehicles, I think there's opportunities where we would want to try and bring some technology and offer it to partners, right, where we're both benefiting from that partnership. But as far as like taking something and white labeling it and trying to monetize it and generate software margins, that's not of interest to us. The question is, are there brands approaching us to sell new cars through us? No. That would be nice. I think the franchise model is really hard and very entrenched and highly regulated and all of those kinds of things. And the used car market is enormous. So, we think we're going to kind of keep our heads down and try and stay focused. Sorry, I'll come back to you, I promise. Say that again?
Service contracts, warranties.
Yep.
How many different, I know your model is trying to keep it simple.
That's right.
How many warranties do you have? 2 warranties, 3 warranties?
Yeah, the question is, how many warranties do we offer? And the answer is N, right? We want to experiment in the user interface with offering 1, with offering 2, with offering 3, with offering a matrix. And we haven't done anything super sophisticated there yet. But frankly, as you all know, there are N permutations of what your deductible is and how long the term is. I mean, it's infinite. Yeah, exactly. So there are so many offerings, and what we think is, how does that integrate with your financing? What is the right offering for any car customer combination given their financing and given all the data that we have? And I think we'll get smarter there, but we're not doing any rocket science at the moment. I don't think we've disclosed that publicly, but it's worse than yours, I would imagine. Yep. Great question. How are we handling warranty and other repairs, service? We do not provide service ourselves because our reconditioning centers are out in the middle of nowhere and far away from our customers, right? And so we partner with an administrator, and basically you can take your car absolutely anywhere, and any certified center that you want to get it fixed. We offer a 100-day warranty with every vehicle sold, the limited warranty that kind of akin to a manufacturer warranty, and then the vehicle service contract, same deal. We're starting to get a little bit more into, in our app experience, helping people find a great place to get serviced, but it's still sort of early days there. Sure. The question is the gross profit inclusive of recon expense? Absolutely it is. Yeah, we can't change, GAAP, generally accepted accounting principles. We gotta do what's legal. And so our cost of goods sold is buying the car at auction, transporting it to our reconditioning center, fully loaded recon expenses, everything associated with the transaction. It's in the figures, yes. Yeah, so with minimal customer interaction, what are the key points we vet? We're still a lender, right? And as a lender, our underwriting has to be the same level of rigor of underwriting that a bank would have. And so driver's license verification, and then conditional on car-customer combination, do we need proof of income, proof of residency, proof of employment, whatever the steps are, our systems will say, given this credit risk, these are the things that we need to know. We allow customers to upload those documents, and we have then processes and systems to verify. And so it's akin to any other underwriting process. So two-part question. One is, what is our turn? And second, do we have sort of a concierge offering where people can call in and request specific cars? Is that right?
Yeah, I mean, so you're a traditional dealership, even if you're doing on auto traders, so we can simply ask about a car and questions.
Yes. Okay, great.
Try to sell a car. Are you guys at anything
Yeah.
trying to move the customer along?
So to the absolutely. So to the turn question, early on, and yes, we control turn very, 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 very aggressively. And early on, we had much slower turns than industry because we believed that it was important for us to have a diversity of inventory. And so we had a lot of supply and growing demand, and therefore turn is relatively slow. But we believed in the diversity of supply as an important part of building our brand, right? Then, as we continue to launch new cities and spend on marketing, we would hold our supply fixed, but add demand, and that brought turn down. And so I think what we've publicly said is we're in kind of the low 60s from purchase at auction through delivery to the customer's door. But we have very, very granular control over that number just based on how much inventory we hold at any given time. And we're just trying to balance the right diversity of inventory with the right economics. The second question is, yes, we have a contact center that is 14 hours a day, 7 days a week. We also have a conversational AI, a chatbot, so that's 24/7. That's another interesting opportunity for technology in our businesses, is that a chatbot can only answer questions that a computer is capable of answering, right? And so anything that actually requires a human to decide, a chatbot cannot provide that answer. But in our systems, when you get your soft credit pull and get your finance terms, a chatbot can get your finance terms. Or when your trade-in valuation is automated, a chatbot can get your trade-in valuation. When the delivery schedule is automated, a chatbot can tell you when your car is going to come or what documents we need and those kinds of things. So we're investing pretty heavily in our AI on the chat side as well.
Are you guys currently using documentation fees in any of your locations? Do you guys use that in your gross profit calculations?
That's a great question. We don't. We have $0 doc fees nationwide, and that is a kick in the teeth in states like Florida and things like that, where we're just at a disadvantage. Period. Are we getting credit for that in the minds of customers or not? I don't know. It's hard to get credit for something like that, but it's something that we do. Yeah. So the question is, what are the comp structures and sort of the archetypes in our BDC? We call them customer advocates. There's a huge thing on the wall, not meant to be derisive, but it says we sell cars, but we're not car salesmen, and that's because we focus on service. And that means we're pretty mediocre car salesmen, to be totally honest. And so we look for people with that real service orientation, and it's incumbent on me, leading the technology side of the house. Our CEO very generously reminds me that every time someone calls in, it's because I screwed something up. And so, generally speaking, we want the website to answer your question or the chatbot to answer your question or whatever so that you can take the next step in your process in self-service. But when that doesn't happen, we want to make sure you're getting exceptional service. And so we're trying to provide great tooling for them and make it so that they can focus on service and not having to be an F&I expert. So the question is, how do we handle repossessions? We don't GPS the vehicles, and I think we handle them exactly the same way that anybody else would. What we try and focus on is keeping default rates as low as possible, right? So offering lower prices on vehicles basically means are conditional on a lower monthly payment. There's a lower default rate for that customer, and we're trying not to have as many defaults as possible. They happen, and when they do, that's part of our servicer who services our loans also has repossession capabilities. I don't think we've disclosed that publicly, and I can't do that. Our ratio of wholesale to retail inventory. So I don't think we've disclosed the details there, but let me try and give you a rough sense. The reason we have a wholesale business is because we take in trade-ins. And so we don't wholesale cars that we put on the website. Once they're on the website, we're going to write them down until they sell. And so we focus on moving our retail inventory through our retail channel. If we acquire a car from a customer that doesn't meet our retail standards, that's when it goes to wholesale. And I don't off the top of my head recall what we've disclosed. I can just say it's a very growing segment of our business. Is we really are focused on acquiring cars from customers because it's a great customer offering that consumers love, and it's a great source of inventory for us. But if you want to have an offering that says, we'll buy your car, it's hard to say unless it doesn't meet these particular standards. So we've built a profitable wholesale business as well. It's growing fast, but I don't recall what we've disclosed.
Can you touch more on how you're doing trades? Like, how do you value trades online?
Yeah. Question is, how do we value trades online? A couple things is we believe that there's a large margin for error in vehicle valuation, period. That you put 5 appraisals on the same car, you're going to get a pretty decent distribution. And that margin for error means that even if you use a machine to do it that has margin for error, you can still be sort of as correct as a portfolio of humans, generally speaking. So we want as much data as we can possibly get. So we're going to use that license plate or that VIN to check Carfax and AutoCheck and get as many data sources as we can behind the scenes. And then we also know that if we're wrong by a little bit, it's going to go to our reconditioning facility, and sometimes we're going to be wrong on a positive way, sometimes we're going to be wrong on a negative way, but we watch the margin characteristics of the whole portfolio. No, our philosophy is to pay as much as humanly possible. The trade or vehicle value is a completely isolated economic value proposition from the rest of the transaction. And so the vehicle's worth what it's worth to us. We say, if this vehicle is going to be retailed, here's how much money we think we can make on that car, and therefore bid as much as we can to make that much money. Or if we think it's going to wholesale, here's how much we think we're going to be able to wholesale it for, bid as much as we can to make that desired margin that we want, and optimize around that. They don't submit pictures now. Generally speaking, we find that people are pretty honest. We ask them what the condition is it drivable, are there engine lights on, those kinds of things. And we find that generally speaking, people are honest. They want a fair deal. If you lied, then we can, there's the asterisk that says if you misrepresent, we can change the value. Our philosophy is not to do that. We don't want to do that. You have to try and screw us for us to do that. Sir? Right. So the question was on interest rates in subprime, and I think we have to wind up, so this will be the last one. In subprime, there are usury caps and all kinds of considerations around what you're able to do state by state, and we just are trying to constantly understand and optimize around the conversion elasticities of down payment, monthly payment, loan term, APR, vehicle price, how all that fits together for any given customer. And so that's all machine learning and algorithmically determined. And then on, what was the other question? I apologize. Disposing. Oh, so wholesale. We've just built our own wholesale business. So when we take in a car that we're not going to retail, we partner with OVE and ADESA and the other platforms. We hold those cars at our reconditioning centers or logistics hubs, put them up for sale, and sell them online. All right. Well, thank you so much for showing up. I know it's been a long week. Thank you for being here.